Withdrawal. Retirement is the situation in which a person stops working because he or she has reached a certain age or conditions that allow him/her to access a pension or a periodic income that guarantees his/her sustenance. Retirement can be mandatory retirement. This is the one that occurs when the person meets the legal requirements to access a public retirement pension, such as, for example, the minimum age, the number of years contributed, etc. Voluntary retirement. This occurs when the person decides to stop working for personal or professional reasons, without having to meet the legal requirements to access a public retirement pension. In this case, the person can choose to receive a private pension or an income from savings or investments. Retirement implies an important change in people's lives, since it means ceasing to receive a salary and becoming dependent on a fixed or variable source of income. For this reason, it is important to plan for retirement in advance and take into account aspects such as the level of income desired to maintain the lifestyle and cover basic needs, the level of expenses foreseen to face possible unforeseen events and contingencies, the level of savings and investment necessary to generate the desired income, the level of risk that can be assumed to obtain the expected profitability, the adequate level of protection to guarantee financial security. Retirement planning. Retirement planning is the process by which an individual defines his or her objectives and strategies for achieving the desired level of income when he or she retires from work. Retirement planning involves the following steps. Establish objectives. Consists of determining the time at which one wishes to retire from work, the desired level of income during retirement, and the estimated length of time one expects to live after retirement. Evaluate the current situation. Consists of analyzing the current income and expenses, as well as the assets and sources of financing available for retirement. Calculate the financial gap. Consists of estimating the difference between the desired level of income during retirement and the expected level of income from available sources of financing. Design the action plan. Consists of defining the necessary actions to cover the financial gap, such as increasing savings and investments, reducing expenses, diversifying income sources, etc. Execute and review the plan. Consists of implementing the defined actions and monitoring compliance and results, as well as adjusting the plan according to changes that may occur in the environment or in personal circumstances. Retirement accounts, IRA, 401k. Retirement accounts are financial instruments that allow you to save and invest money for your future retirement with tax advantages. There are two main types of retirement accounts, IRAs and 401ks. IRAs, individual retirement accounts, are individual accounts that you can open with a bank, insurance company, mutual fund or stockbroker. You can contribute up to an annual limit established by law, which for 2023 is $6,500 if you are under age 50 or $7,500 if you are age 50 or older. There are two types of IRAs, traditional and Roth. The traditional IRA allows you to deduct your contributions from your taxable income, which reduces your current tax burden. However, when you withdraw the money, you will have to pay income taxes on the full amount withdrawn. In addition, you will have to begin taking mandatory withdrawals when you reach age 72. The Roth IRA does not allow you to deduct your contributions from your taxable income, which means you pay taxes now. But when you withdraw the money, you won't have to pay taxes on the full amount withdrawn, as long as you meet certain conditions. Also, you won't have to make mandatory withdrawals for as long as you live. 401ks are employer-sponsored savings plans that allow you to contribute a portion of your salary to an investment account. Your employer can match or supplement your contributions up to a certain limit. The annual limit for contributions to a 401k in 2023 is $20,500 if you are under age 50 or $27,000 if you are age 50 or older. There are two types of 401ks, traditional and Roth. The traditional 401k works similarly to the traditional IRA. Your contributions are deducted from your taxable income and you pay taxes when you withdraw the money. You will also have to start making mandatory withdrawals when you turn 72 or when you retire, whichever is later. The Roth 401k works similarly to the Roth IRA. Your contributions are made with after-tax money and you don't pay taxes when you withdraw the money. However, you will have to start making mandatory withdrawals when you turn 72 or when you retire, whichever is later. In choosing between an IRA or a 401k, and between a traditional or Roth account, you should consider several factors, such as your current and future income level, your age, your life expectancy, your risk tolerance and your financial goals. Real estate. Real estate is real estate that consists of a piece of land and everything on it, such as buildings, houses, trees, etc. Real estate can be classified into different types according to its use, such as residential, commercial, industrial, agricultural, etc. Real estate is a form of property that has an economic value and can be bought, sold, rented or mortgaged. Real estate is one of the main sources of wealth and investment in the world. Many people buy real estate to live in it, to generate rental income, or to speculate on its future value. Real estate is also important for urban development, land use planning, environmental protection and cultural heritage. Real estate investment. Real estate investment consists of allocating an amount of money to the acquisition or improvement of real estate in order to obtain a return. The return can come from two sources: the income stream generated by the real estate property from its use or exploitation, for example, rent, and the appreciation or increase in value of the real estate property over time, for example, appreciation. Investment in real estate has several advantages, such as the possibility of diversifying the investment portfolio, protection against inflation, taking advantage of tax benefits, access to mortgage credit and the generation of equity. However, it also has some risks, such as lack of liquidity, market volatility, maintenance costs, taxes and legal regulations. Mortgages and refinancing. A mortgage is a loan obtained from a financial institution to buy or build real estate. The real estate serves as collateral or security for the loan, which means that if the borrower defaults on the loan, the financial institution can keep the real estate to recover its money. A mortgage is composed of three elements: the principal, the amount borrowed, the interest, the cost of the loan, and the term, the time to repay the loan. Refinancing is a transaction that consists of changing the terms of an existing mortgage to ones that are more favorable to the borrower. Refinancing may involve changing the lender, reducing the interest rate, extending or shortening the term, changing the interest rate, fixed or variable, etc. The objective of refinancing is to reduce the total cost of the loan or improve the debtor's repayment capacity. International finance. International finance is the set of economic activities that involve agents from different countries and have effects on monetary flows, prices, exchange rates and economic policies. International finance can be divided into three main areas: the international capital market, the international foreign exchange market and international macroeconomics. The international capital market is the space where financial assets are traded between economic agents from different countries. Financial assets are securities that represent rights to future income or other assets. Examples are stocks, bonds, mutual funds, etc. The international capital market allows the transfer of resources between countries with different levels of savings and investment. The international currency market is the space where the currencies of different countries are exchanged. Currencies are the means of payment accepted by economic agents within a country. Examples are the US dollar, the euro, the Japanese yen, etc. The international currency market allows trade in goods and services between countries with different currencies. International macroeconomics is the study of economic relations between countries and the effects of economic policies on the level of activity. Employment, inflation, trade deficits or surpluses, external indebtedness, etc. International macroeconomics analyzes the determinants and consequences of global imbalances and international financial crises. Exchange rates and foreign exchange markets. The exchange rate is the price of one currency in terms of another currency. For example, the exchange rate between the US dollar and the euro is the amount of euros that can be obtained for $1. The exchange rate is determined by the supply and demand of currencies in the international foreign exchange market. Foreign exchange markets are the places where the currencies of different countries are exchanged. Foreign exchange markets can be classified into two types: the spot market and the forward market. The spot market is the one that operates with transactions that take place at the moment or with a maximum term of 2 working days. The forward market is the market for transactions agreed for a future date. Exchange rates and foreign exchange markets are of great importance to the world economy, as they affect international trade, foreign investment, competitiveness, inflation, economic growth, etc. Exchange rates and currency markets are also subject to the influence of political, social, cultural and psychological factors. International investment. International investment is the placement of financial resources in assets located in other countries in order to obtain a return. International investment can be carried out in two ways: direct investment and indirect investment. Direct investment consists of acquiring a majority or significant interest in a foreign company or establishing a subsidiary or branch in another country. Indirect investment consists of purchasing financial assets issued by foreign entities, such as stocks, bonds, mutual funds, etc. International investment has several advantages, such as the possibility of accessing larger and dynamic markets, diversifying risk, taking advantage of differences in costs and regulations, benefiting from tax incentives and subsidies, etc. However, it also has some risks, such as political and legal uncertainty, exchange rate fluctuations, trade and cultural barriers, unfair competition, etc. Ethics in finance. Ethics in finance is the set of principles and values that guide the behavior of financial agents, such as banks, companies, investors, auditors, regulators, etc. in the exercise of their economic activities. Financial ethics seeks to promote transparency, integrity, responsibility, fairness and respect for the rules and rights of others. The importance of ethics in finance lies in the fact that it contributes to generating trust and credibility in the financial system, which favors economic and social development. In addition, financial ethics help prevent and combat corruption, fraud, money laundering, tax evasion, abuse of power and other illicit or immoral behavior that can cause serious damage to society. Some examples of ethical principles that apply in finance are: the principle of honesty implies acting truthfully, sincerely and consistently, without deceiving or withholding relevant information from others. The principle of fairness implies treating everyone fairly and impartially, without discriminating or favoring anyone for arbitrary or personal reasons. The principle of prudence implies acting cautiously and sensibly, evaluating the risks and consequences of financial decisions, without assuming irresponsible or excessive commitments. The principle of professionalism implies performing financial functions with competence, diligence and quality. Respecting the technical and legal standards in force, as well as the code of ethics of the profession. The principle of loyalty implies acting with loyalty and respect for the legitimate interests of clients, employers, partners and colleagues, without incurring in conflicts of interest or disloyalty. Corporate social responsibility. Corporate social responsibility, CSR, is the voluntary commitment of companies to sustainable development, i.e., to the economic, social and environmental well-being of society. CSR implies that companies not only seek to maximize their profits, but also to generate a positive impact on their environment. Meeting the expectations and needs of their stakeholders, such as clients, employees, suppliers, shareholders, local communities, etc. The importance of CSR lies in the fact that it contributes to improving the reputation and competitiveness of companies, as well as creating shared value for society. CSR also helps to promote innovation, quality, efficiency and transparency in business management. Some examples of CSR actions that companies can take are: adopting responsible environmental practices, such as reducing energy and water consumption, recycling waste, using biodegradable or environmentally friendly materials, etc. Promote the social and cultural development of the communities in which they operate, supporting educational, health, cultural or sports projects. Respect the human and labor rights of its employees and suppliers, guaranteeing decent working conditions, social security, continuous training, equal opportunities and non-discrimination. to offer quality products and services that meet the needs and expectations of its customers, guaranteeing their safety and health. Comply with its fiscal and legal obligations, as well as with the ethical principles that govern its activity. To dialogue and collaborate with its stakeholders to identify their demands and interests and establish relationships based on trust and mutual respect. Regulations and compliance. Regulations are the set of legal norms that establish the requirements and conditions that financial agents must comply with in order to carry out their economic activities. Regulations aim to ensure the proper functioning of the financial system, protect the rights and interests of consumers and investors, and prevent or sanction illicit or abusive conduct. Compliance is the set of measures and procedures adopted by financial agents to ensure that they respect and apply the regulations in force in the exercise of their economic activities. Compliance implies having a culture of ethics and integrity, as well as systems of internal control, auditing, risk management and information reporting. The importance of regulations and compliance lies in the fact that they contribute to generating confidence and security in the financial system, which favors economic and social development. In addition, regulations and compliance help prevent and combat corruption, fraud, money laundering, tax evasion, abuse of power and other illicit or immoral conduct that can cause serious damage to society. Sustainable finance. Sustainable finance is finance that takes into account the environmental, social and governance impacts of economic and financial activities. The objective of sustainable finance is to contribute to sustainable development, i.e., to the well-being of present and future generations, while respecting the planet's ecological limits and promoting equity and social justice. Sustainable finance can be applied to different fields, such as banking, insurance, investment, accounting, auditing, regulation or politics. Some examples of sustainable finance practices are the integration of S criteria into financial analysis and decision-making, both by providers and users of capital. Financing projects or activities that generate environmental or social benefits, such as renewable energy, energy efficiency, sustainable mobility. Green agriculture, education, health or financial inclusion. Disclosure of non-financial or extra-financial information by entities participating in the financial market, such as companies, banks, investment funds or credit rating agencies. This information makes it possible to evaluate the performance of entities and their contribution to sustainable development. The incorporation of incentives or penalties depending on compliance with objectives by financial institutions or their clients. For example, more favorable conditions can be offered to loans or bonds that are linked to environmental or social goals. The active and responsible participation of investors in the corporate governance of the companies in which they invest, exercising their rights as shareholders and promoting good practices. Cooperation among the different actors in the financial system to foster the development and implementation of voluntary or mandatory standards. Norms, principles or guidelines to guide sustainable finance. Sustainable finance has several potential benefits for the environment, society and the economy. Some of these are: reducing greenhouse gas emissions and mitigating climate change, conservation of natural resources and biodiversity, improving air, water and soil quality, prevention and management of environmental and social risks associated with economic and financial activities, The creation of green and decent jobs. Increasing innovation and competitiveness. Strengthening social inclusion and access to basic services. Promoting transparency, accountability and trust in the financial market. Socially responsible investment. Socially responsible investment, SRI, is a form of investment that takes S criteria into account in addition to traditional financial criteria. SRI seeks to generate an economic return for the investor while contributing to sustainable development. SRI is based on the principle that financial decisions have environmental, social and ethical consequences that must be considered. SRI can be realized through different strategies or methods, which can be combined with each other. Some examples are: exclusion consists of eliminating from the investment universe those companies or sectors that do not meet minimum ESG standards or that are involved in controversial activities such as armaments, tobacco, gambling, nuclear energy or fossil fuels. Positive selection consists of choosing to invest in companies or sectors that have better ESG performance than their competitors or that are leaders in sustainability. ESG indices or rankings can be used to identify these companies or sectors. Integration, this consists of incorporating ESG criteria into the financial analysis and valuation of companies or sectors, together with traditional financial criteria. In this way, the impact of ESG factors on investment risk and return can be estimated. Thematic investing consists of investing in companies or sectors that are engaged in activities related to a specific sustainability theme, such as climate change, circular economy, health, education or gender equality. Impact investing consists of investing in companies or projects whose main objective is to generate a positive and measurable impact on the environment or society, in addition to a financial return. Impact investing is usually carried out in sectors such as renewable energy, sustainable agriculture, social housing or microfinance. Shareholder activism, this consists of exercising one's rights and duties as a shareholder of a company to influence its ESG strategy and management. This can be done by voting at general meetings, engaging in dialogue with management, submitting proposals or resolutions, or participating in coalitions or investor initiatives. SRI has several potential benefits for the investor, for companies and for society. Some of these are: improved long-term financial performance by considering ESG risks and opportunities that may affect the value of investments. Portfolio diversification and reduced volatility by investing in emerging sectors or sectors with higher growth potential. Alignment of investments with the investor's personal or institutional values, by supporting companies or projects that contribute to sustainable development. Generating a positive impact on the environment and society, by promoting ESG best practices among investee companies and sectors. Contributing to the United Nations Sustainable Development Goals, SDGs, which are a global agenda to eradicate poverty, protect the planet and ensure peace and prosperity for all. Green finance and green bonds. Green finance is a type of sustainable finance that focuses specifically on environmental issues, especially climate change, mitigation and adaptation. Green finance seeks to mobilize financial resources for projects or activities that reduce greenhouse gas emissions, increase energy efficiency, promote renewable energy, improve natural resource management, protect biodiversity, or facilitate the transition to a low-carbon economy. Green bonds are a green finance instrument consisting of debt securities issued by public or private entities to finance green projects or activities. Green bonds have the same financial characteristics as conventional bonds, such as term, coupon, or price, but are differentiated by the specific and exclusive use given to the capital raised. Green bonds must comply with principles and standards that ensure their transparency and credibility, such as the ICMA, International Capital Market Association, Green Bond Principles, GBP. Green bonds have several potential benefits for issuers, investors, and the environment. Some of these are: for issuers, broaden their investor base by accessing those seeking green or socially responsible investments. Enhance their reputation and corporate image by demonstrating their commitment to sustainable development and the environment. Access cheaper sources of funding or with better terms by benefiting from the growing demand for green bonds and potential tax or regulatory incentives. For investors, diversify their portfolio and reduce their exposure to climate risk by investing in projects or activities that contribute to climate change mitigation or adaptation. Obtain a financial return comparable to that of conventional bonds, by assuming a similar level of credit risk. Generate a positive impact on the environment, by supporting the transition to a green, low-carbon economy. For the environment, increase investment in projects or activities that reduce greenhouse gas emissions, such as renewable energy, energy efficiency, sustainable transportation, or carbon capture and storage. Increase investment in projects or activities that increase resilience to climate change, such as water management, coastal protection, reforestation, or sustainable agriculture. Increase the awareness and commitment of financial actors to sustainable development and the environment. Fintech. Fintech is a term that comes from the combination of the words finance and technology. It refers to the use of technology to offer financial services in a more efficient, innovative, and accessible way. Some examples of fintech services are: digital payments, which allow sending and receiving money through mobile apps, virtual cards, or QR codes. Online loans, which facilitate access to credit for people or companies that cannot obtain it through traditional channels, such as banks. Crowdfunding platforms, which connect entrepreneurs with investors willing to finance their projects in exchange for a reward or a stake in the business. Robo-advisors, which offer personalized financial advice based on algorithms and customer data, without human intervention. Cryptocurrencies, which are digital currencies that work with a technology called blockchain, which we will talk about later. The benefits of fintech services are: cost reduction, as they eliminate intermediaries, commissions, and paperwork. Greater speed, since they are carried out in real time and without timetables or geographical restrictions. Improved customer experience, as they offer greater convenience, security, and personalization. Financial inclusion, as they reach people or sectors that do not have access to traditional financial services. The challenges of fintech services are: Regulation, as they must comply with the legal standards of each country or region where they operate, which may limit their expansion or innovation. Trust, as they must generate credibility and reputation among users, especially in sensitive issues such as money or personal data. Competition, as they must face both other fintech players and traditional financial services, which may adapt or imitate their business models. Innovations in financial technology. Financial technology is constantly evolving and new ideas and solutions are emerging every day to improve financial services. Some of the most recent and promising innovations are open banking, which allows users to share their financial data with third-party service providers, such as fintechs or retailers, to obtain better offers, products or benefits. Biometric banking, which uses users' physical or biological characteristics, such as fingerprint, iris or voice, to identify them and authorize their financial transactions, increasing security and convenience. Social banking, which integrates social networks with financial services, allowing users to interact with their contacts, share information, carry out transactions or receive recommendations. Green banking, which promotes environmental and social sustainability in the financial sector, offering products or incentives that encourage energy saving, responsible investment or support for social causes. These innovations represent opportunities to create added value for customers, differentiate from the competition and contribute to economic and social development. However, they also involve risks and challenges, such as privacy protection, cybersecurity or regulatory adaptation. Cryptocurrencies and blockchain. Cryptocurrencies are digital currencies that do not depend on any government, central bank or centralized authority. They are created and transferred using a technology called blockchain, which is a kind of distributed and immutable ledger where all transactions are recorded. The blockchain works through a network of computers or nodes that communicate with each other using a cryptographic protocol. Each node has a copy of the blockchain and can verify the validity of transactions. When a transaction is made, it is grouped with others in a block, which is added to the blockchain after being validated by the majority of the nodes. This ensures the security, transparency and traceability of transactions. The advantages of cryptocurrencies and the blockchain are decentralization, as there are no intermediaries or authorities controlling or manipulating the system. Speed, since transactions are carried out in minutes or seconds, regardless of distance or time. Economy, as commissions, taxes or exchange rates are eliminated or reduced. Inclusion, as access to financial services is facilitated for people or regions that do not have them. The drawbacks of cryptocurrencies and blockchain are volatility, as the value of cryptocurrencies can fluctuate greatly depending on supply and demand, speculation or external events. Illegality, as cryptocurrencies can be used for illicit activities, such as money laundering, fraud or terrorism. Irreversibility, since transactions cannot be cancelled or modified once they have been made, which can lead to losses or errors. Complexity, as technical and financial knowledge is required to understand and use cryptocurrencies and blockchain. Financial risk management. Financial risk management is the process of identifying, measuring, controlling and mitigating risks that may affect the profitability. Solvency or reputation of a financial entity, such as a bank, company or investor. Financial risks are the possibilities of an adverse event occurring that generates economic losses or reputational damage. Some types of financial risks are: market risk, which is the risk that the prices or interest rates of financial assets, such as stocks, bonds or currencies, will change. Credit risk, which is the risk that a borrower will not pay its financial obligations, such as a loan or an invoice. Liquidity risk, which is the risk of not being able to sell or buy a financial asset without affecting its price or incurring additional costs. Operational risk, which is the risk of suffering losses due to human, technical or external failures, such as errors, fraud or natural disasters. The benefits of financial risk management are: prevention, as it makes it possible to anticipate and avoid possible negative scenarios or financial crises. Optimization, as it improves the performance and efficiency of financial operations. Confidence, as it allows to generate credibility and security among clients, shareholders and regulators. The challenges of financial risk management are: uncertainty, as the future and all possible adverse events cannot be accurately predicted. Complexity, since a large amount of data and information from various sources and markets must be analyzed. Adaptation, since it is necessary to keep abreast of regulatory, technological and social changes that may affect financial risks. Financial risk identification and measurement. The identification and measurement of financial risks are the first stages of the financial risk management process. They consist of recognizing and quantifying the risks faced by a financial institution. Financial risk measurement involves selecting appropriate methods and tools to estimate the probability and magnitude of risks, applying mathematical or statistical models that capture the characteristics and behavior of risks, calculate numerical indicators that express the level of exposure or potential impact of risks, such as value at risk, VAR, expected profit and loss, IPL, or economic capital, EC. Compare the results obtained with the limits or targets established by the financial institution. Some examples of methods and tools for measuring financial risks are: sensitivity analysis, which measures how the value of an asset or portfolio changes in the face of variations in one or more risk factors, such as price, interest rate or exchange rate. Scenario analysis, which measures the impact of extreme or unlikely events on the value of an asset or portfolio, such as a financial crisis, war or pandemic. Monte Carlo analysis, which uses randomized simulations to generate possible future scenarios and estimate the probability distribution of outcomes, such as the final value of an asset or portfolio. The identification and measurement of financial risks are fundamental activities for the effective management of financial risks. Since they make it possible to understand and evaluate the risks faced by a financial institution and to make the appropriate decisions to control and mitigate them. I'm sure that after watching this video, you feel more prepared and confident to understand and manage your personal and professional finances. You have learned concepts, techniques and tools that will allow you to make better financial decisions in any scenario. But don't keep this knowledge just for yourself. Think of all the people who could benefit from this valuable and practical information. Your family members, your friends, your colleagues, your clients. They all deserve the opportunity to improve their financial situation and their quality of life. That's why I ask you to share this video with all of them right now. Not only will you be doing them a great favor, but you will also be contributing to create a more educated, responsible and financially prosperous society. Remember that knowledge is power, and power multiplies when it is shared. If you like this video and want to continue learning more about finance, I have a surprise for you. In the video's description and in the comments, you'll find a link that will take you to an exclusive resource I've prepared especially for you. It's something that will surprise you and help you a lot in your professional life. I can't reveal it here, because I want you to discover it for yourself. But I assure you that you will not regret it. So don't wait any longer and click on the link right now. It's a once-in-a-lifetime opportunity that you can't pass up. I promise you it's worth it. I hope you enjoyed this video and learned a lot about finance. I want to thank you for your attention and your interest in this important topic. I invite you to put into practice everything you have learned and to continue training and updating yourself in this dynamic and challenging field. Remember that finances are a powerful tool to achieve your goals and dreams, but also a responsibility that you must assume with judgment and ethics. As Benjamin Franklin said, "A penny saved is a penny earned." So take care of your money, invest it wisely and make it grow wisely. I wish you much success and happiness in your financial journey. See you next time. Imagine a world where sharing and collaboration can not only transform your financial life, but also revolutionize the global economy. Could we be on the verge of unlocking the best-kept secret that could be the answer to sustainable financial prosperity for all? Today we embark on an odyssey to uncover the unexplored secrets of the collaborative economy and how it can transform your finances. Get ready, because what you're about to discover could change the trajectory of your financial future forever. At a time when economic inequality is at an all-time high, many people are struggling to stay afloat. The collaborative economy is emerging as a beacon of hope, but it remains a mystery, uncharted territory for many. What if I told you that there are ways to rediscover and redefine our economic interactions that can bring stability and prosperity like never before? In different corners of the world, there are communities that are thriving through an economic approach that defies conventional norms. These communities are capitalizing on innovative methods that put collaboration and fair exchange at their core. We're talking about initiatives where goods and services are exchanged in ways that maximize mutual benefit, creating a network of support and prosperity that extends far beyond the individuals involved. Over the decades, we have seen how traditional economic practices have fostered fierce competition and unbridled accumulation of resources by the few. But the real secret, which lies in the shadows, is that there is an alternative, one based on cooperation, community, and sharing, which allows for a more equitable distribution of wealth and resources. This approach, though underappreciated and underexplored, may be the key to unlocking a new era of economic prosperity for all. According to experts from world-renowned institutions and leaders in the field of economics, we are on the cusp of a revolution that could reshape our understanding of economic practice and personal finance. A growing consensus among leading academics and practitioners in the field suggests that a transition to a more collaborative economy is not only beneficial, but necessary for a sustainable and equitable future. While this may sound almost utopian, there are already actors who are using these hidden and little-known concepts with surprising results. Imagine companies and communities quietly moving toward a collaborative economy, implementing strategies that allow them not only to thrive, but also to build a network of mutual support and sustainability. This is just a glimpse of what's to come, and what we'll explore next is even more eye-opening and transformative, promising to uncover methods and techniques that could change our perception of business as we know it. You won't want to miss what's coming next, because what we're about to reveal has the power to not only transform your personal finances, but also reshape our global economy toward a more inclusive and prosperous future. Join us as we navigate this little explored path, where each turn reveals a deeper secret, a more powerful technique that can usher in a new era of economic cooperation and shared prosperity. Now is the time to be part of this revolution and rediscover the limitless possibilities of the collaborative economy. Join us on this eye-opening journey. I want you to know that I am sharing this information with you not because I have an ulterior motive, but because I truly believe that together, as a community, we can transform the way we live and thrive. It is a path that scares me a little because we are deviating from established norms, but I am here, just like you, navigating this vast and unknown ocean, searching for answers. Because at the end of the day, we are no different. I am also a person seeking change, a person seeking a better future for all. We are in this together, as friends, discovering together the secrets that can revolutionize our lives. Let me tell you a story that was once told to me. There was a small community in a remote part of the world where people had created an economy based entirely on cooperation and fair exchange. Although they did not have much in the way of material wealth, they prospered in a way that many of us could only dream of. Happiness, harmony, and prosperity were evident in every corner of this community. This story made me think deeply about how our lives could be transformed if we were to apply these principles to our own economy. Get ready, because what's coming next is truly electrifying. We're going to delve into the depths of the headings we outlined earlier and discover insights that may leave you completely stunned. But first, I am going to present you with two statements, one true and one false. You'll want to remember this well, as it will be an indispensable tool later on. This is just the beginning, and trust me, you won't want to miss what's to come. Challenges for the collaborative economy in the current economic landscape. Claim A. The collaborative economy is being actively suppressed by multinational corporations. Claim B. The collaborative economy is being promoted by all nations of the world. Rediscovering and redefining economic interactions. Claim A. Collaborative economic interactions can significantly reduce global inequality. Claim B. Collaborative economic interactions have little or no impact on local communities. Integrating collaboration and fair exchange. Statement A. Fair exchange is a modern concept that has emerged only in the last decade. Statement B. Fair exchange has historical roots and has been an integral part of diverse cultures for centuries. Remember these statements well. Later, we will unravel the truth behind each of them. But for now, let's focus on the heart of our discussion, the true centerpiece that will guide us on our journey of discovery. We are embarking on a deep journey to reveal every aspect promised in our title. We will look at how you can rediscover the secrets of the collaborative economy and use them to transform your finances. We'll explore practical strategies you can implement in your daily life, community initiatives that are breaking down barriers, and techniques industry leaders are using to create meaningful change. Together, We'll dive into this uncharted world and find ways to integrate collaboration and fair exchange into our lives, revolutionizing our perception of business as we know it. You're about to embark on an adventure that could change your life forever. 1. Practical strategies for implementing the collaborative economy in your daily life. Local currency and barter. Implement systems for exchanging goods and services that do not rely on conventional money, fostering community and local relationships. Responsible and conscious consumption. Encourage the consumption of local and sustainable products, minimize your environmental footprint, and promote the circular economy. Collaborative economy investment. Supporting and investing in platforms and businesses based on collaborative economy principles that promote a more equitable and just economic cycle. 2. Innovative community initiatives that break down barriers. Producer and consumer cooperatives. Form or join cooperatives where producers and consumers work together to ensure fair prices and product quality. Community energy projects. Invest or participate in community-led renewable energy projects that promote self-sufficiency and sustainability. Community education and training. Implement educational programs that foster collaborative learning and the development of skills necessary for a collaborative economy. 3. Techniques used by industry leaders to drive meaningful change. Strategic alliances. Establish partnerships with other companies and institutions to share resources and knowledge, creating synergies that benefit all parties. Sustainable development. Implementing business practices that prioritize sustainability and community well-being over short-term profits. Participatory management. Promote a management model in which employees participate in decision-making, fostering a more inclusive and collaborative corporate culture. 4. Ways to integrate collaboration and fair exchange into various aspects of our lives. Community habitats. Create or join communities that promote community living, sharing resources and common spaces. Volunteerism and community activism. Participate in volunteer initiatives that promote community well-being and foster cooperation and fair exchange. Crowdsourcing and crowdfunding platforms. Use crowdsourcing and crowdfunding platforms to foster collaboration and fund projects of common interest. Dear viewers, the defining moment you've been waiting for has arrived. It's time to connect all the precious wisdom we've accumulated so far. Let's dive into the fascinating world of each of the titles we've mentioned, unraveling each layer with exhaustive precision. Don't miss a single detail, because now it all begins to connect in ways you couldn't have imagined. The challenge of the collaborative economy in today's economic landscape. In today's society, the collaborative economy faces a number of challenges, primarily from entrenched multinational corporations. These corporations, fearful of losing their dominance, are employing tactics that could stifle the growth and expansion of the collaborative economy. Resistance comes in the form of intense lobbying, political pressure, and often disinformation campaigns. But despite these challenges, advocates of the sharing economy continue to fight valiantly, presenting innovative solutions and strategies that promote equitable sharing and a fairer distribution of resources. It is a struggle that lies at the heart of a broader shift toward a more egalitarian society focused on collective well-being rather than individual profit. Rediscovering and redefining economic interactions. Rediscovering and redefining economic interactions is an ongoing process that seeks to recalibrate the balance of economic and social power in global society. Through collaborative economic models, we can challenge persistent inequality by creating systems that promote cooperation, reciprocity, and social justice. These systems not only redistribute wealth more equitably, but can also facilitate access to opportunities, resources, and knowledge that were previously limited to a privileged few. It is a quiet revolution that is reshaping the way we interact economically. Empowering local communities and individuals to take charge of their economic and social futures, and redefining what true prosperity means. Integrating collaboration and fair exchange. Integrating collaboration and fair exchange into our lives is not new. In fact, It has been an integral part of diverse cultures for centuries. From ancient barter systems to modern cooperatives, this concept has always been a viable alternative to conventional profit-driven economic systems. This process of integration involves a return to our roots, recognizing and valuing practices of equitable and cooperative exchange that foster solidarity and human connection. It is an invitation to reject unbridled competition in favor of systems that promote equity, justice, and sustainability, thus fostering a more balanced and... As you can see, these advanced concepts are not merely theoretical, they have direct and powerful implications for our daily lives. By understanding how these elements are interrelated, we can begin to use them strategically to benefit not only individually, but also as a global community. Join us on this exciting journey toward a more just and cooperative society. The adventure is just beginning. Now, viewers, it's time to reflect on everything we've explored today. I'd love to hear your thoughts in the comments section. How do you think the collaborative economy could change your financial life? What are your thoughts on the challenges facing this economic model in today's landscape? I look forward to hearing your ideas and thoughts. Dear friends, get ready to embark on a unique expedition where we'll break down these complex concepts into simple analogies and practical examples. We will bring these concepts to life in a way you've never experienced before. The challenge of the collaborative economy in the current economic landscape. Think of it as a young tree struggling to stand out in a dense forest of larger, more established trees. Despite the odds, it seeks the sunlight and extends its branches into new opportunities and sustainable growth. Rediscover and redefine economic interactions. Think of this concept as a river that changes its natural course over time, adapting and flowing through new, previously unexplored pathways, creating a more equitable and prosperous ecosystem for all the species that inhabit it. Integrating cooperation and fair exchange. Visualize this principle as a beehive where each bee contributes to the well-being of the entire community, demonstrating that cooperation and fair exchange can lead to a more harmonious and productive society. Dear viewers, I have a special surprise for you. Next, I will present you with a series of unique interactive activities designed to explore the most intriguing corners of the concepts we have discussed today. Prepare yourself for an unforgettable learning adventure. Create a virtual cooperative. Form virtual groups to discuss and create a virtual cooperative. The goal is to simulate a cooperative environment and understand the challenges and benefits this system can provide. Fair exchange game. Design a board game or video game that focuses on creating fair exchange relationships so that players can experience firsthand how to create equitable economic relationships. Community mapping project. Conduct a community mapping project to identify the resources available in your community and how they could be shared equitably to benefit the entire community. My dear viewers, what we have shared today goes far beyond a simple video. It is a call for a revolution of consciousness, an invitation to rethink our relationship to economics and society. By sharing this video, you are taking an important step toward creating a more inclusive, just and collaborative society. I invite each of you to become an ambassador for change by sharing this vital message with all those who care about building a better future. Before we say goodbye, I have a special surprise for you. I invite you to visit the link in the video description and also in the comments. I promise you that what you'll find there has the potential to revolutionize your professional life in ways you can't even imagine. Don't miss it. After this deep dive into the secrets of the collaborative economy, I'd like to leave you with a reflection that resonates deeply with today's spirit. Only together can we forge a future where wealth is shared, not monopolized. May this message inspire you to march with hope and determination toward a brighter, more cooperative future. Until next time, Brave pioneers of the new world we are building together,